U.S. diesel is produced in the U.S., but diesel fuel is used around the world. And the biggest diesel market is in China, and they get their oil from the Middle East.
What economic conditions are generally the most bullish for gold?
This year, politics are going to be very important, both on a global basis and on a domestic basis.
Talking about the metals and energy with Jeff Christian, managing partner of the CPM Group. Gold has fallen from its highs of $5,600 in late January to now $4,500. Over the course of the last month and a half, there's been a lot of volatility, with gold rebounding to $5,400 at its early March peak before the Iran war took it lower. We're going to find out why a war caused gold to fall lower and what's next. Jeff, welcome back to the show. Good to see you.
David, it's always a pleasure to talk with you and chat about the markets.
It's very timely we're having this conversation. We're recording on the 25th of March. And just earlier this week, the CPM Group released your 2026 Gold Yearbook. Tell us about the core thesis of this year's outlook and any updates to the outlook that you've made to the yearbook since last time we spoke, which was before the Iran war.
Right. Well, the yearbook is about 288 pages long. The first review and outlook chapter talks about what's happened last year, both within the gold market, investment demand, central bank purchases and sales, fabrication demand, supply, as well as the macroeconomic and political environment that inspired those trends within the gold market. Then we have large chapters on investment demand, central bank activity, fabrication demand, supply, markets, and prices. And, as we've done this is our 40th year as CPM Group producing these reports. If you include the reports that we did when we were part of Goldman Sachs and J. Aron, those go back to 1971 or so. So we've been doing this for about 55 years collectively. And they are the definitive work. As I described it to one person today, if you really wanted to know about the gold market, this 288-page book is the best place to get the basic data, unbiased and accurate, on gold supply, demand, prices, data, statistics, and analysis of what it is. So this year's report, for example, in the official demand section, we have quite a bit of information about what's going on with central banks and their attitudes toward the dollar and treasuries. But we also have a few paragraphs where we talk about how there are errors in the collective thinking in the gold market about what central banks are doing with gold, whereby you have people who have they don't just look at central banks' purchases and sales from monetary reserves. They're also now seem to be including sovereign wealth funds and institutional investors and other things. So they grossly overestimate how much central banks are buying for monetary reserves. So we discussed that. We discussed some of the misinformation and misimpressions that people have about investment demand and about the overall market.
Let me flip over to a chart. So yes, I do encourage everyone to check out the CPM Group's Gold Yearbook. I'll put a link down below so people can click on it and access it. Jeff, I'm looking at the gold spot price on my screen versus the DXY. So I've asked a lot of people why gold fell on the day the Iranian regime was struck by the U.S. and Israeli forces on the 28th of February. And you would think, logically, if gold is a safe haven, it should go up. But as time has proven over and over again, the world tends to flock to the dollar during times of extreme duress, which is what happened on the 28th of February. Right. The dollar, which is the blue line here, spiked up and gold went down. What's interesting to me is that the dollar continued to hover around the same range. It's come down somewhat, this downward trend in the DXY, and gold has not inversely responded to the dollar coming down somewhat, meaning gold hasn't gone up. And in fact, the selling pressure on gold has intensified. So maybe comment, broadly speaking, on the relationship between the dollar and gold and why it is that sometimes, not always, sometimes flows into one asset leads to outflows into the other.
Yeah. Gold and the dollar are the two safest haven assets that people have. So when things get when risks or uncertainties or anxieties rise, sometimes people pour into the dollar, sometimes they pour into gold, sometimes they pour into both. Now, I would take exception with some of the things that you were saying, and maybe not exceptions, but I would add nuances.
Sure.
If you look at your chart, the dollar had come off in late January as gold reached $5,600 an ounce.
That's right.
The dollar rose through February and into March, right? So what you saw, yes, you saw a spike up when the United States and Israel attacked Iran, but that was a continuation of a trend that had gone on for a month. On the gold side, yeah, the gold price fell, but it fell earlier and then it recovered, as you said, and then it was sort of trending lower. And there were several factors. I would cite four factors behind the gold price, and I would point out that the gold price, while it did trend down after the initial attack, it was a couple weeks later. It was last week when the price really fell sharply, and I'll get back to that. But the reality is that, okay, gold prices plunged from $5,500 to $4,100 on Monday. It's a 20 some odd percent decline, but it's all the way back to where it was in December. And it's double what it was at the beginning of 2024. Gold is still at record levels. So I look at the gold price decline since February 28th, but especially over the last week, and I see various distinct things. First off, the war was a couple weeks old. It hadn't lasted 5 days. It was going to continue. The second thing is that the FOMC met last week. And the FOMC meeting, I think, was perhaps more important to the decline in gold prices than the war, because the FOMC said, hey, inflationary pressures are much more persistent than the markets and we had thought. In late August, the Fed said, hey, we think that we may have to cut interest rates more than we had thought over the next year or two because of weak economic conditions. And that actually was the beginning of this sharp increase in gold prices from the end of August into the end of January. And then last week, the Fed came along and said, no, it's not going to happen. Inflation is much more virulent. Yes, we're worried about the state of the economy. We're worried about rising unemployment and low employment, new jobs figures. But inflation seems to be more of a problem right now. So we are not cutting interest rates now. And in the dot plot, we're showing you that we don't think interest rates have a scope to decline significantly through the rest of 2026 or 2027, depending on what happens with the war and depending on what happens with the potential of recessionary conditions, if not an outright recession. So I think that the Fed's actions and statements last week were more important in the sell-off. There are two other factors. One was just plain, simple, good old profit taking. You had a lot of people pour into gold from September into January. The price was moving sideways. It was kind of trending down toward the end of February. It's a good time to take profits. And perhaps the most important thing is that Dubai was closed by the war. And Dubai is the entrepot not just for the Islamic markets, from Morocco to Indonesia, it's also the entrepot for India and other South Asian nations. And there are flights every day from Mumbai to Dubai bringing in gold scrap to be refined. And there are flights from Dubai to Mumbai bringing refined gold to sell and silver. And that whole Dubai market has really been shut down by the airspace being shut down. So it's not that, in the Islamic world, throughout the Gulf region, the GCC countries, as well as Turkey and India, there were a lot of people who would like to have bought gold and silver over the last 3 weeks, 3.5 weeks now, but they simply can't get it because Dubai is shut. So I think it's a combination of those four factors that led to the gold price to decline. And I would point out, even though the gold price has declined, it's still at record levels.
The current U.S. fiscal deficit stands at over $1 trillion. And so if the government spends more than it takes in by the order of $1 trillion every single year, what does that mean for the purchasing power and value of your savings? Well, historically, governments don't fix deficits by cutting spending. They print their way out of debt. And when they do, hard assets like gold rise, while dollar-denominated savings lose purchasing power. Gold has been hovering around $5,000 an ounce. JP Morgan is projecting $6,300 this year, and central banks in India, China, and Japan, and Eastern Europe are already moving out of U.S. treasuries and into gold at the fastest rate in decades. If your IRA or 401k has no hard asset exposure, that's worth a conversation. My friends and sponsors of today's video, Priority Gold, are Forbes' #1 rated gold provider with thousands of 5-star reviews. 3 simple steps, no paperwork, no pressure, no obligation, and they'll do a free portfolio review so you know exactly where you stand. Call 866-407-6456. That's 866-407-6456, or text David, D-A-V-I-D, to 24999 to get your free precious metals playbook and up to $10,000 in free silver with qualifying purchases. Again, text David, D-A-V-I-D, to 24999 or 866-407-6456. I think the concern from some investors in the gold space is not so much that it's still at record levels, is that the momentum seems to be still on the downward trajectory. And so if you look at how gold has behaved in prior bull cycles in 2011 and perhaps even 1980 as an example, gold is pretty much doing exactly what it was doing in 2011, double top, retracing by the order of double digits in a very short amount of time, then rebounding, and then the following year in 2012 and beyond was, as you know, underperformance. In other words, another 50% retracement from its highs. And so,
well, the big sell-off was in April of 2013,
right,
when it fell from 1580 to 1280.
But does this look like the beginning of, let's say, the end of 2011 or 2012 to you, Jeff?
No, it doesn't. And the reason is I look at the reasons why investors have been buying gold and silver, and I think they're worse now. You know, they haven't gotten better. If you look at 2011, 2012, you know, there were people who sat there for their entire lives saying the Treasury is going to collapse, and the Treasury's interest rate assets are going to be downgraded. And in August of 2011, the Treasury's law was downgraded for the first time in its history. And that was at the same time that you had the sovereign debt problems in the southern tier of the Eurozone, especially focusing on Greece. So you had a lot of pressures there. And by September, the gold market said, wait a second, we've just had this cataclysmic thing that gold promoters have been telling us to be worried about for 40 years. The Treasury has been downgraded. And you know what happened? The demand for U.S. Treasury securities rose. So gold peaked in September of 2011. And the economy didn't collapse, and the world didn't collapse, and the dollar didn't collapse. In fact, the dollar started rising. Why? Because people were buying treasuries. Why? Because their interest rates went up because they'd been downgraded. You know, so that was a completely different situation. Fast forward to today, that's not happening. Investors, despite what the gold bugs will tell you, investors are not dumping the dollar. Your chart shows that. The dollar is not rising because people are dumping the dollar in treasuries.
Yeah, that's right.
Right? You know, no one's dumping the dollar. People look at the word. My clients, who are mostly investors, institutional or high net worth individuals, are saying to us, hey, this is exactly what we've been expecting to happen about this time. We don't want to sell our gold and silver and take profits. We want to keep our physical metal because we look at the world and it's not getting better, it's getting worse. So we've been doing a lot of hedging for investors over the last 18 months because they look at the world and they say, yeah, this is not where I'm going to sell. The people who were selling over the last month or so, or the last few weeks, have been shorter term momentum driven opportunistic investors who basically said, hey, the gold price has been rising, let's buy. And they bought into the ETFs and other gold assets. And now they're taking their profits because, hey, that move is over. If we're right and the price resumes its increase, they'll be back. But the real key is getting Dubai reopened.
Nobody has a crystal ball, but when's that going to happen, Jeff?
Someone once introduced me as saying, I don't have a crystal ball, I just walk this way.
Yeah.
Crude but funny. Yeah, I don't have a crystal ball, but I can tell you that when the United States and Israel attacked Iran, we said this is not a 1 week war. And there are three levels that we're looking at. First is the hot war, which it could continue for a long time. Trump is clearly trying to back out. He said, oh, yeah, let's wind this down. Like, boy, no hard feelings that I bombed the hell out of your country. I'll leave now. That might not happen. And Israel has said, you can leave, but we're going to continue this war. We want to make Beirut look like Gaza. So the hot war is the first part, and that's going on, and no one knows when it's going to end. The second part is even when the hot war stops, not only has the straits been mined, but you have had significant damage to natural gas and petroleum production and distribution facilities in Qatar, Saudi Arabia, UAE, Kuwait, and Iran. Those things are going to take months, if not years, to rebuild. So that's going to be an ongoing problem in the oil market, which is going to weigh on overall economic conditions. And then the third and most important thing is the United States has accelerated the deterioration of international cooperation and its hegemonic power by attacking Iran. It's been deteriorating for years, if not decades, but this just accelerated it. And you have politicians from China and Taiwan and Europe and every place else saying, hey, we can't count on the U.S. for anything anymore, given the state of its government. And that's good for gold and silver.
Okay, I want to come back to Jeff's gold and silver price outlook. So stay tuned. I'm going to ask for Jeff's outlook and levels, key levels to watch out for throughout this interview. So stay tuned for that. Comment down below what you think Jeff's going to say. I want to flip over to my screen now and take a look at where diesel comes from. The EIA has explained here, most of the diesel fuel consumed in the U.S. is produced in U.S. oil refineries. So my question is, why are diesel prices skyrocketing? What does the Strait of Hormuz closure have to do with diesel prices going up to $5 a gallon in the U.S., which, by the way, feeds into trucking, feeds into everything else that we consume through trucking?
Yeah.
But the diesel was produced in the U.S. Can you comment on this?
Well, U.S. diesel is produced in the U.S., but diesel fuel is used around the world. And the biggest diesel market is in China, and they get their oil from the Middle East. Many of the other large diesel markets are Japan, the Philippines, Indonesia, and they all get their oil from the Middle East and Europe, which has a mixed source. It has been relying, I think, more on the U.S., but it also gets diesel. So I think the diesel price is moving higher. Why is it moving higher in the United States? Because the oil companies can extract a higher price.
Maybe there should be a bifurcation in the diesel markets like WTI and Brent. I'm just saying.
Maybe there should be. Yeah.
Yeah. Well, the tips, this is interesting because if we take a look at the TIPS ETF, which tracks inflation expectations, that's actually been going down.
Yeah.
Ever since the beginning of the Iran war, which, I don't know, does this make sense to you?
Yes, because when you have higher oil prices, that has an inflationary component, but it also reduces expenditures across the rest of the economy. So with higher oil prices, you start worrying about recessionary conditions. You see people buying less goods, less food, less disposable stuff, less clothing. You run the risk of recessions, and you see less inflationary pressure on other sectors of the economy because oil and natural gas are demanding it. You mentioned earlier 1980, and it's very interesting. I don't think that the corollary is perfect, but if you look at 1979, 1980, gold and the silver peaked in January of 1980. They rose very sharply in the second half of 1979 as oil prices, I think, quadrupled during that period of time. And you had supply disruptions in the Middle East with American hostages in Iran.
Yeah.
And January 1980 not only saw gold and silver peak, it was the beginning of a double dip recession that was the deepest recession in the post-war period at that time.
Yeah.
So there are some corollaries there. There are some significant differences, but it is interesting that you've seen in the first quarter of this year gold and silver peaking, and we don't know what the economic outlook is because the data hasn't really been coming out, but we've seen weaker employment figures, and
Right.
we've seen other indications that we are seeing sharply reduced economic activity. Perhaps not a recession, but sharply reduced economic activity.
And gold hasn't risen on this recession post 1980. I mean, it's climbed throughout the 70s, but one would expect a safe haven asset, if it actually is indeed a safe haven, to continue climbing up during weak economic activity. Can you just explain why it hasn't done that?
I'm sorry, could you repeat the question? I didn't quite understand what you were.
There was a recession in 1980 and 81, right?
Right.
A safe haven asset, in theory, should go up during economic downturns when stock markets and equities and risk assets overall face downturns during a recession. Yet, the opposite has happened for gold. Why has gold gone down during the 1981 recession?
Well, there are a couple of things that were going on. First off, the correlation is very poor between gold prices and recessions. If you look at the history, most of the gold price increase in the going into the 1980, 83, 82 recessions occurred prior to the start of recession. If you look at the most recent period of time, we saw gold prices go sharply. Well, and then once we got into the recession, the price came off, right? If you look at the Audis, gold prices started rising in 2001. They rose for 7 years into that recession. The recession started at late 2007. Gold prices rose through the recession, 2007, 2008, 2009, and then they continued to rise in 2010, 2011 after the recession, partly because of the sovereign debt crisis in Europe, partly because of the expectation that the United States treasuries would be downgraded because of the excessive deficits and debt that the U.S. government were taking on. So you can see that sometimes recessions cause the gold price to fall. Sometimes they don't. Sometimes the gold price is responding to things other than economic conditions. But once you get into a recession, sometimes various things happen. One of the things that will happen is if people are suffering from a recession, as they were in both 2007, 2009, and in 1979, 1980, 81, they will sell gold to raise money. They'll sell gold jewelry, they'll sell gold decorative items, and some of them will sell gold bullion investments in order to survive. The second thing is that price, I keep having to point this out to investors these days. Gold and silver are commodities. And there's mine supply, there's secondary supply, there's fabrication demand, there's investment demand. In the case of gold, there's also central bank demand. And the price has an effect on that. The average all-in sustaining cost for gold mining today is $1,700 an ounce. You've got gold at $4,500 an ounce. It's more than 100% higher than the average cost of production on an all-in sustaining basis, right? That means that some of those 2 billion ounces of known proven reserves are probably going to be mined. It also means that there's a lot of scrap that can be sold. There's a lot of investors who bought gold at $1,000 or $2,000 that are selling. There are some central banks that have been selling in the first quarter, apparently needing foreign exchange reserves, specifically US dollars. So the high price has an effect on gold supply and demand, and gold supply and demand have an effect on the high price.
And economic activity has an impact to play on monetary policy, which has an impact to play, which has a role to play rather on gold. How concerned should we be, though, Jeff, about the higher oil prices? How transitory, as Jerome Powell might say, is this higher oil price? If you take a look at prior oil spikes in 2022 when Russia invaded Ukraine, and during the Gulf War, during the Iraq invasion, oil spiked, but in most of these cases, geopolitical risk premiums didn't stay very high. What do you think is going to happen this time?
I think that the energy markets will normalize, if you will, and the prices will come down. I'm actually more concerned about natural gas prices staying higher because I think a greater portion of global liquid natural gas comes from Qatar and the Gulf region through the Straits of Hormuz. So I'm probably more concerned about natural gas prices staying higher than I am petroleum prices. The reality is there is a lot of petroleum that's produced outside of that region. And this is not the 1970s. It's not, so I think that you probably will see at some point over the next month or so, oil prices coming back down.
What does that mean for Fed policy then? Should they be making policy around the higher oil price, which has been brought up several times by reporters at the last FOMC conference?
I think oil prices are very important, but again, they've cut both ways in terms of inflationary pressures. Oil prices are very inflationary in and of themselves, but they also defer and distract spending from everything else. So they have recessionary pressures as well as disinflationary pressures on other sectors of the economy. And you're already seeing that. You're seeing people cut back on on discretionary purchases. You're seeing some people saying they're not going to take vacations this year. Other people say they're having trouble with food. And it also factors into other factors that have been raising the inaffordability of living, not only in the United States, but around the world. So I think that the oil prices are important, but they're only one piece of the puzzle. And you never see a recession starting because one thing happens. It's always a combination of factors. And they say, oh my God, that was bad timing that happened at that time. And it was bad timing that the United States attacked Iran when it did. But it did. So, we'll have to see where it is. But I don't think that oil prices in and of themselves alone are the problem.
If you had to summarize it, what economic conditions are generally the most bullish for gold? We already talked about recessions. Economic booms are equally inconsistent, if not more so. So what should we be looking at as gold investors?
Actually, the best time, there's no single model. You'll see sometimes that gold does very well going into a recession, the late stages of an economic expansion. Inflationary pressures are building, but equity prices are very high, and bond prices actually are relatively low going before you get into the recession. And so what you find is a lot of investors saying, hey, I've made a lot of money in the stock market. I'm feeling really wealthy, but the economy seems to be heading into troubled waters. I think I should take some of my wealth out of the stock market and put it park it in gold and silver. And so you often will see, as you saw in 1979, people that the gold price will do very well in the late stages of an economic expansion. It's kind of counterintuitive, and it's more of a North American and European thing. In Asia, these guys tend to be full in. So I'm going to be in the stock market until it's falling, and I'm going to bet that I can be one of the first guys out the door. But that will sometimes happen. A combination of strong economic growth, high inflation, and governments unable to control the inflation because they're worried about the recessionary conditions. That's probably the ideal circumstance for stimulating gold. And also, international wars.
Okay, well, what about this chart? Let me just pull up gold one more time and overlay this with yields. When yields are falling, shouldn't that be good for gold? Okay, so this if I go back 3 months, let's just do 3 months. I think the 10-year yield since February has been a better explainer for gold's movement just on the surface, just looking at the chart, than the DXY or inflation expectations. It's been the most consistently inverse, right? Yes. And if you look at how this is the blue line is the U.S. 10-year yield, and if you look at how that's bottomed at around March 1st, which is when gold actually started going down, and it's been rising ever since, and gold has been falling ever since. Maybe explain this logically for the audience. Why is it that sometimes, and again, not always, because if you look at the beginning of 2026, that wasn't the case, but sometimes when you get an inverse relationship in yields and gold, that seems to be the explanation here.
Sometimes that is the case, but the correlation in monthly changes in gold prices and treasuries is 16%. And if you look at it on a real basis, it's like zero. So gold is a good portfolio diversifier for a bond investor because it sometimes will rise with bond prices. Sometimes it will fall with bond prices. Sometimes it just has no relationship. But what you've seen right now is that yields are rising because people are worried about the state of the economy and inflationary pressures. And you've got real interest rates on treasuries, and the gold price was still rising. And again, you can't really just look at the last 3 weeks. And you have to take into account the fact that at $4,500, gold is off 20% from its peak a month and a half ago, but it's still sharply higher than it's ever been before.
So maybe give us a sense of which levels to look at next. I promised the audience you would give us your outlook. If we didn't buy in gold, did we miss this rally, Jeff?
I think you missed a short-term rally, but I think it still makes sense from a long-term basis. The gold price can fall to $4,000. Or it could fall to $3,800. It can actually fall even further and still be in a long upward trend. We think that the gold price probably will stay above $3,800, $4,000 in the near term, and that the price will probably consolidate with a slight upward bias over the next year, and move somewhat higher starting in the last 4 months of this year and going into 2027, and possibly going into 2028. From a long-term perspective, we think that the gold investment demand will stay at record levels. It was at record levels last year. We've never seen net investment demand of physical gold as high as it was last year. Our expectation is going to be even higher this year. We're looking at the potential that you could see the price consolidate for a few months. But given the political instabilities, both within the United States, within other countries, and on a global basis, that midsummer pause may not occur. Then you get into the final 4 months, you've got a very dangerous electoral situation in the United States that's going to get nastier. And that's going to cause more people to want to buy gold.
Your alma mater, Goldman Sachs, sees $5,400 this year. My question isn't really regarding their outlook. I just wanted to put it out there that other firms are equally bullish. However, I wanted to ask you, throughout your career doing this for many decades, has a narrative for holding and buying gold changed? In other words, were there certain periods of time when gold was more favored as an inflation hedge, a risk-off hedge, and I guess more recently a geopolitical risk premium hedge, or have these narratives more or less stayed consistent throughout the last couple of decades?
we have like six narratives,
Yeah.
six reasons for investors to buy gold. And it's in our gold yearbook. We have a chart with, where we rate these things over time. And you will see, for example, in the 1970s, that gold was really an inflation hedge. And it was also a portfolio diversifier because back then you didn't have a lot of the derivative securities and investment. You didn't have ways to hedge your stock and bond portfolio other than gold and silver, right? So portfolio hedge was very important. Political risk has taken more emphasis really over the last 2 years or so. Uh, it's become perhaps more important than economic risks, but it has been gaining stature really for several decades. Currency risk was greater in the 80s, but it's less important now for a variety of reasons. So we have these six factors that are sets of factors that determine whether or not investors want to buy more or less gold. And yeah, the relative importance and significance varies over time depending on the economic and political environment.
I ask this because it's important to understand the core narrative now in order to make the assumption, in order to have the proper assumptions for forecasting is what I'm trying to say.
Right.
So everywhere I go on mainstream channels and news, I read Goldman Sachs or JP Morgan, or it doesn't matter which shop, they're projecting higher gold prices on the back of stronger central bank demand or perhaps ongoing Iran conflict. And all these are assuming that the narrative for buying gold will remain constant throughout this year. But perhaps there's going to be a structural shift in how people perceive gold in the next year or two. But you don't think that's the case for now?
I think that you've been seeing a structural shift or a secular upward movement in investment demand for 26 years now, and that's going to continue in the long run. This year, politics are going to be very important, both on a global basis and on a domestic basis. So you have a lot of hostility within various nations. The United States obviously is very important, but you have a lot of dissension within various European countries and within various Asian countries. And the political risks, I think, are taking precedence over economic risks at this time. And that's probably going to continue through this year.
Okay. What about silver, Jeff?
I like silver. It's much more volatile than gold. Gold's given up like 22% of its spike. Silver's given up 50% of its spike. But I do like silver. The silver market's relatively tight. One of the key things that we've seen over the last year or so, which we saw in 1979 and we saw in 2005, is that the gross sales of silver by investors has fallen off. In the late 1970s and in the early '80s, you had a lot of investors who were selling at the same time other investors were buying. And we saw that again in the period 2022, 2025. But since the middle of 2025, those investors who had silver that were selling have stopped selling. They've really pulled back from the market for a variety of reasons, but one of which is the price has been rising since the end of August. And it's like, okay, I want to sell my silver. I can finally recoup my losses that I've been sitting on for years. Some of these investors bought silver at the peak in 2011. Some of them bought in the peak at 2021. They're saying, okay, I want to sell my silver. I can now sell it at a profit, but I look at the world, I look at the state of the world, and I look at the rate of increase in silver prices, and I think I'm going to wait before I sell because I just might get a higher price. And as long as that is the persistent view on the part of silver investors, they're going to refrain from selling and they're going to continue to buy. And
Remember a few years ago,
Yeah.
years ago when people were talking about how silver is used in munitions, Tomahawk missiles, for example, and it was critical in weapons and missiles. I mean, it still is. But if that narrative were important, then you should see silver skyrocketing because their U.S. burned through $3.6 billion in munitions in the first 24 hours or something like that.
Right.
And
I guess you could take that as proof that that narrative was not accurate.
Okay. Anyway, well, when does your silver yearbook come out? Just so we stay tuned for that.
The silver yearbook comes out May 27th.
Okay, May 27th. So pick up the gold yearbook, link down below, and then we'll stay tuned for the silver one. Thank you so much, Jeff. We'll have you on soon to talk about the silver yearbook, and thank you for your update today.
Well, thank you for having me.
Thank you for watching. Don't forget to like, subscribe.